Hello, Business 330 students. This is Professor Hassey. It's week 7 introduction video, and we're back live this week, tomorrow night, Tuesday at 6 p.m. after our computer problems of last week. But I wanted to go over a couple of things for you to prepare for tomorrow evening. First of all, we're going to talk about capital budget analysis, doing spreadsheets of determining return on investment of a investment in assets. And that all leads into our discussion, beginning our discussion on the California Best Trucks case that you have due the last week of our term. Hopefully most of you have read that. We're going to review that and begin putting the puzzle together for that case. We're also going to be talking about beta as far as risk from Chapter 12 and the cost of capital from Chapter 13. Our first topic out of Chapter 12 tomorrow night will be the capital asset pricing model, which is a formula for determining the cost of equity. What would it cost a company to issue stock? What would it cost a company to keep your shareholders satisfied? And that's a theory, and it's called the capital asset pricing model. We need to be familiar with this formula. We're going to look at problems 11 and 19 on page 387 of your textbook to practice this definition of the capital asset pricing model. It means it's a relationship of risk and return to the amount of return you have to pay. In other words, the greater the risk, the higher the return to the stockholder. The lower the risk, the less return you have to pay because the stockholder doesn't have as much to lose. So we're going to talk about that relationship tomorrow night. Capital asset pricing model. We're also going to talk about in Chapter 13 the cost of capital. More specifically, it's called the weighted average cost of capital. The cost that we have to pay as a combination of debt and equity to our investors who give us the money to invest in assets. And that's a structure of the capital asset pricing model we just talked about in Chapter 12, but also the definition of a capital structure of a company. On their balance sheet, what makes up the assets? The mix of long-term debt and equity is a combination of that. Those are interest-bearing or cost-bearing investments that you have to pay. Accounts payable is a short-term debt that you don't have to pay any cost. You just have to pay it back in 30 days. But the mix of long-term debt and equity all has long-term costs. That capital structure will drive the cost of capital. The weighted average cost of capital, as I said, is the expected rate of return on a portfolio for all its cost-bearing securities, both debt and equity. So that's what we mean by the cost of capital. It's the weighted average of debt and equity returns for the investors. We'll be looking at problems 4, 5, and 9 from pages 412 and 413. Once we complete this analysis of Chapter 12 and 13, you now have all the pieces to put together the California Best Trucks case, and we'll talk about that tomorrow night. This case will take you some time. It's quite involved, but it's part of the requirement of taking finance here at the University of La Verne. So we move into week 7. A lot going on, the final pieces of the puzzle to complete the California Best Trucks case. You're going to practice this in assignment number 3, which I'll post to you tomorrow evening, which will be a capital budgeting spreadsheet work for a practice for all of this. So look forward to seeing you all tomorrow evening, 6 p.m., and have a great Monday evening. We'll see you all then. Thanks, everybody.